Let me read you this title from the Washington Post. It says, lower mortgage rates won't make buying homes more affordable. Now, you might hear that and say, what do you mean? If I could buy a home right now at a 3% mortgage, if I wanted to buy a $500,000 home, well, it's going to be much cheaper than if I had to pay 7% to borrow that $500,000. But this is where things are a little bit unique in our economic system right now, because when mortgage rates go down, you don't get to just buy the home for $500,000. Then you have to pay a premium to buy the home. Because what we've been seeing, and this has been happening throughout 2023, is anytime we see a little dip in mortgage rates, the same thing happens. Everybody wants to go out and buy a home. And so as soon as we see a little dip in mortgage rates, you then see everybody call up their mortgage banker and everybody calls up the realtor. They go look at the homes that are available for sale and everybody makes an offer on the homes that are out there. And now all of a sudden, you go from the slow housing market where no one's getting an offer to then all of a sudden, 10 offers on a home, and now you have to outbid each other to buy a home. And so we're seeing this like real volatile housing market where 1 month you're seeing a huge slowdown in the housing market, and then the next week when interest rates drop, everybody goes out and they start buying homes, and that pushes home prices higher. So we're facing a very unique dilemma where, the higher mortgage rates have slowed down the housing market on a general level. But then anytime we see a little drop in mortgage rates, we see a quick shift and turnaround in the housing market where people then want to go out and start buying homes again. And this is where now, what is going to come in the housing market? Well, it goes back to the Federal Reserve Bank. And I know I sound like a broken record at this point, but if the Federal Reserve Bank stays true to their word to bring inflation down, that means that they are going to continue raising interest rates. And it looks like they're going to have to continue raising interest rates if they want to bring inflation down. And that could go against a lot of people's opinions and wants and beliefs, because that's going to cause more pain in the economy. But if you want to bring inflation down, you're going to have to stay aggressive with interest rates. And so now the Federal Reserve Bank is working to raise interest rates to slow down demand. And one of the byproducts of that is, that's going to put higher pressure on mortgage rates. And as mortgage rates go up, that puts downward pressure on home prices. And so a lot of people are now wanting to buy a home. They're ready to buy a home, but they're unsure where home prices are going to go. And everybody has a prediction. Everybody has a guess. Just wait it out or buy it now before home prices go higher. The reality is it's going to ultimately come down to what the Federal Reserve Bank does. If they stay true with their word of wanting to bring inflation down, that means interest rates are going to continue going up, and interest rates are going to go higher than what people expect, which means it's going to continue to put higher pressure on mortgage rates. And if you continue to see higher pressure on mortgage rates, that makes borrowing money more expensive. Making borrowing money more expensive makes buying a home less affordable. That reduces demand for the housing market. On the flip side, if the Federal Reserve Bank says, okay, you know what, our economy is taking a nosedive. We're seeing a lot of layoffs. We're seeing unemployment go down. Forget what's going on with inflation. We're now going to start cutting interest rates. Then mortgage rates are going to fall too. And if mortgage rates fall, you bet that people are going to want to go out and take advantage of the lower mortgage rates, which means people are going to want to go out and buy homes, which means you'll see more bidding wars on homes, which would push home prices up. And you can start to see why that's a dilemma, because if the Fed starts cutting interest rates to stimulate the economy, home prices would go up. And if home prices go up, that would impact inflation. A third of our CPI, 33% of the CPI data is reflected on the housing market. So if home prices start to go up, where do you think CPI and inflation numbers are going to go up? That would impact our inflation numbers. And so if inflation starts to go up, the Fed was able to kind of put a Band-Aid on the economy problem, but then inflation becomes an even bigger problem. And this is that rock and a hard place that the Federal Reserve Bank is in. And when it comes to the housing market, this is where we're going to see a lot of shakeups. And real estate now is becoming much more sector by sector, because the housing market has been very strong the last number of years, but other industries haven't, like the office sector. That sector of the real estate market, commercial real estate market, hasn't been as strong as other sectors, and it's very localized. When people buy a home, they don't just buy a home based off of how much the price of the home is. They buy a home based off of what the mortgage will cost them. And we saw this in explicit detail over the last number of years, where people didn't really care about how much they had to pay for the home. They were willing to outbid homes by 6 figures as long as the mortgage rate made sense. So this is where now understanding what's going on in the real estate market isn't a one answer question, because you have the housing market, you have office real estate, you have the other commercial real estate, and then you have it differentiated by neighborhoods. And certain neighborhoods are getting hit in the office sector while other neighborhoods are booming in the office sector. And so different cities across the country have completely different cultures when it comes to going into the office. And this is where we are going to see a shakeup. I mean, if you look into some of the bigger cities across the country, there's a lot of vacant office buildings, multi-story office buildings that are sitting there vacant. And the reason why that's important is because over the next couple of years, we're going to see about half, according to a lot of economists, about half of the total corporate real estate debt readjust. Because commercial real estate debt is not a 30-year fixed rate mortgage. It readjusts every few years. And so now if we see about half of the commercial real estate debt readjusts, that means these people that are holding on to the office buildings, that are owning the office buildings, a big chunk of them are going to see their mortgage rates on their offices readjust. And if interest rates continue to stay high, that means now you could see your payments go up by 30 or 40, 50%, because nothing changed except your debt readjusted. And so now if you're not making enough money because your office building is vacant, your costs are going up by 20, 30, 40, 50%, that's going to put you in a tough situation. And many people might not be able to qualify for a refinance because if your building is sitting vacant, the valuation of your building might fall. And if the valuation of your building might fall, you might not be able to refinance. And banks might not be willing to give you a loan, which means you might be forced to sell your building in the coming years. And if you're forced to sell your building, well, we could see an increase in supply, which could also impact the valuation of these buildings. And this is where now when it comes to the housing market and the real estate market, understand that if there's one factor you want to pay attention to, this is the Federal Reserve Bank, because interest rates are going to play one of the biggest driving factors as to which direction the housing market and the broader real estate market is going to go. And you also want to pay attention to the economy, because if people don't have the ability to buy a new home because they're struggling to get a job or wages aren't keeping up, well, that's going to continue to impact the housing market and the overall real estate market. But right now, what's impacting the real estate market more than the economy is interest rates. But this is where you want to keep an eye on interest rates and the economy. That way you can keep a broader picture as to what's going on, not just in the housing market, but in every different aspect of our economy. It pays to stay up to date on what's happening, and that's why I created Market Briefs, which is my free financial newsletter, which is why if you have not joined Market Briefs yet, I highly recommend you do so. It's a free and simple way for you to stay up to date on what's happening in the top financial news, with things like the banking sector, the housing market, the stock market, the economy, and everything in between. It's a completely free newsletter. You can read it in less than 5 minutes every morning. And I got the link to how you can read Market Briefs down in the description below. Retirement used to be known as a three-legged stool, where one leg was your pension you got from your company, a second leg was the Social Security you got from the government, and the third leg was your own personal savings or your investments. Well, now what we're seeing happen is that pensions have become a thing of the past because companies don't offer pensions anymore. Social